Novo Nordisk is a stock which is down over 40% from its all-time highs, which it reached in June 2024. And this is because of a variety of things, such as more pharmaceutical companies starting to provide weight loss drugs, their studies being less successful than anticipated, and a huge rise of uncertainty regarding, first of all, the health sector because of the new administration in the US, but also regarding companies which are not American, due to imposed tariffs and other possible regulations, since let's not forget that Novo Nordisk is a European company. However, what has gone wrong? Because from late 2023 all the way up to mid-2024, the company rallied over 70%. Could Novo Nordisk be trading at a very attractive valuation, or is it a value trap? Today we'll be reviewing the price evolution of the company, we'll also be looking at their fundamentals, and as always we will be taking a look at a bullish stance and at a bearish stance in order to build out our investment thesis. So let's jump straight into it. Novo Nordisk is a huge pharmaceutical company from Denmark, and it is the father company of that special drug you may have heard about called Ozempic, which was primarily intended for diabetic use, but it turned out that it is also categorized as a weight loss drug. It started to gain a lot of traction and it started to become very important to Novo Nordisk. Just look at the price chart. The company was rising steadily without major declines or major rises all the way up to 2023, where this drug started to take a lot of traction, and since then, the company went on a massive bull run where it almost tripled its value in 1 year and a half. And let's not forget that currently this company is valued at a market cap of close to $400 billion. And we can better understand the significance of this product when we compare their revenue growth CAGR for the past 3 years, 5 years, and 10 years. Their 3-year growth CAGR has been at 27%. While if we look at the rate in which their revenues have grown every single year for the past 10 years, it's only a 13%, less than half of what it has been in the past 3 years. Currently, this stock is not in a bad position. It's trading at a 26 price to earnings ratio, which is not bad, especially if they manage to keep this 27% revenue growth. We can see that they have a gross margin of 85% and a net margin of 35%, with a 5-year average return on capital employed of 75%. Just to give you a little bit of context, we usually like companies which have this return on capital employed above 15%. But as if this wasn't enough, this company is yielding a 2% dividend yield, which means that it's also attractive for those investors who are seeking safer, more predictable income-generating assets. This graph allows us to visualize the acceleration of growth that this company has not only had in their revenues, but also in their net profit, because in these last 2 years, they have actually had some incredible margin expansion. Additionally, we've also included their free cash flow generation, because that's a metric we also love to compare against their other financials. We can see that their growth actually started to accelerate in 2022, and it hasn't slowed down since. In that first year, since they weren't expecting that huge increase in demand for their products, their margins actually fell while their revenues grew at a very fast pace. However, this effect was only short-lived, as in the following year they managed to increase and expand their margins, expand their net margin to a solid 36%. Now in this last year, 2024, this fell back down to 35%, but these incredible effects combined have managed to double this company's net profit in only 3 years, from 2021 to 2024. Most investors have been thinking that this growth should slow down. However, as we can see in the latest quarter in December 2024, it actually sped up. And just to do a quick check, we always have to ensure that the company's balance sheet can show us that these companies are having sustainable growth. And as we can see, first of all, their assets are way above their total liabilities, which actually shows us that the company is in a very stable position, and we like to see that. But in the other hand, it also shows us that their assets have been increasing quite rapidly, and it looks like liabilities have also been growing at a very similar pace. And now let's jump to the fun part, the review of the different investment theses, one positive and one negative, as we usually like to do. This one is titled, Novo Nordisk, dips like these come once every few years. This article first introduces the company and states what we argued at the start, that most of the price decline was actually caused from a disappointment in their Capricima drug. After the results from the trials came out, the stock fell over 18% in one single trading session. And although this company had a lot of expectations placed on this unique pharmaceutical, it may have gotten to the point where the market is overlooking the rest of the company as a whole. And look at the results that actually caused this huge stock turndown. It says that the trial results actually pointed to a 23% weight reduction, whereas their expectations were a 25% weight reduction. One of the main reasons for this number not being expected, management says, is because only 57% of patients were given the maximum dose of this drug. But honestly, let's not live in the past. Novo Nordisk is a 400 billion market cap company. It should not only live on the expectations of this single drug. It has a very wide portfolio of different pharmaceuticals. Over here we can see that over the period where the stock was falling over 40% from its all-time highs, there were also results from one of their other pharmaceuticals in development, which is called amycretin. This actually made the stock surge over 8% in a single trading session, so it looks like this stock is very dependent on trial results. However, when we talk about the products that they actually have, they're extremely solid. Their sales increased by 25%, with, of course, their obesity care segment growing over 56% in this time period. And as we have seen previously, this is the leading factor of why the company has had such explosive growth in the past 3 years. And just look at this number at the bottom. Their full year free cash flow was over $10 billion for the first time, which allowed it to increase their dividend in one single year by 21%. Name a company which is bold enough to increase their dividend by that amount in 1 year. This must mean that they have extremely good expectations for the following quarters and that they believe that they're very likely to maintain this sort of dividend payout. And when we look at their valuation, it has gotten to the point where we can actually say it's reasonable. This is their normalized PE ratio for the past 30 years, and we can see that currently it may be trading at around their average, whereas a couple of months back it was trading closer to a 40 times earnings and nobody was saying anything about it. However, this could actually signal a very good chance to pick this stock at a discount, if of course you do your due diligence beforehand. As stated here, if we then factor in their current growth, because this company is growing faster now than at any point in history, their forward price to earnings ratio is only 22 times, which is a lot lower than its 5-year average of 31 times. However, in order to just challenge this idea, I don't believe that they will be able to sustain this amount of growth that they have during these past 3 years for the mid or long term. So this forward PE is bound to increase as their growth slows down. One of my main reasons for saying this is that there are a lot of competitors entering the space. However, they've also included a study by Grandview Research where they're trying to value the whole market of obesity treatments, where it was valued at $16 billion and forecasted to grow at more than a 22% CAGR from 2025 all the way up to 2030. So despite there being a lot more competitors to share the market with, the market is forecasted to grow at such a fast pace that there is enough room for growth for all of these competitors at the same time, which is very positive for Novo Nordisk. And what this author actually tries to argue here is that in history there have been no major dips for Novo Nordisk as huge as the one that there is now. However, we also have to consider that in history, there never has been a period where the company has grown at such a fast pace and where their clinical trial studies have impacted their stock prices by such large amounts. We can use this chart as a conclusion for this article, where it's a logarithmic chart which compares the price evolution with their 50-month simple moving average. We can see that the company has always held up against this SMA, but now its valuation has gotten to the point where the company is currently trading right at its 50-month simple moving average, which from a technical perspective could imply that there should be a rebound. However, I prefer to focus on fundamentals rather than technical analysis, but this is just for you to understand their point of view. Now, before moving on the second article, we'll also evaluate some of the risks that are discussed here, where the first one is the one that I implied, where competition is getting tougher each month that goes on in the diabetes and obesity care segment, with companies such as Eli Lilly grabbing a big market share of this company and slowly chipping away at the competitive advantage of Novo Nordisk. The second risk mentioned here, which I don't think he does enough to actually disclose it, is the political risks. There are discussions about placing tariffs even for pharmaceutical products, which would of course affect Novo Nordisk products as it's a European company. And there are even further risks of a stronger regulation in the whole of the US, which is of course Novo Nordisk's largest market when it comes to their obesity care segment. Now we'll move on to the second article, Novo Nordisk, Mounting Challenges. Here the author will again state that there have been many clinical trial studies which have not gone the way that investors or even Novo Nordisk actually expected them to go. The first one being the monlunabant trial, which caused a huge 7% price downturn in Novo Nordisk stock in a single trading session, which, surprise, is another weight loss treatment. A second thing to consider is the Wegovy, which is another one of Novo Nordisk's product, actually declined in sales, and this was one of their flagship products as it was the one leading the charge, as it was one of the main products leading the charge when it came to weight loss products. However, it looks like these prescriptions were down over 7% last quarter, which could show worrying signs. And one of the main factors for this is that the flagship product for their main competitor, Eli Lilly, with their Zepbound, were able to cut their prices by half, which of course created a lot of pricing pressure for Novo Nordisk and caused a lot of clients to go for the cheaper alternative. Additionally, since this article was written a couple of months back, still argued that the price to earnings ratio of the company was not at the point that the investor actually wanted it to be, so it caused them to stay away. Now, in my view, I believe that this is a great company. It has incredible efficiency ratios, very solid fundamentals. However, I believe that it is too dependent on the results from their clinical trial studies, which honestly cannot be projected, forecasted, or guessed by anyone. I believe that's pure luck. I would love this company to have a bit more predictability, because yes, they have been growing at an incredible pace. However, they benefited from being the first company with the best product in this huge market segment. And now that competitors have caught up, are delivering better products and at lower prices, this could mean that Novo Nordisk may face trouble in the following months. However, due to their relatively low valuation and their strong fundamentals, I will actually take a deeper dive with this company. And of course, I will let you know if I find something. So thank you for watching, I hope you enjoyed. As always, this has been the Cashflow Compounder. Join the Patreon for free content and I'll see you in the next one.